Mark Douglas, the disciplined trader. Three words that, for many traders, mark the turning point between chaos and control, between emotional exhaustion and consistent performance. In this video, we are going to walk slowly and deeply through the core ideas of Mark Douglas's classic work, The Disciplined Trader, and what it really means to become a disciplined trader yourself. This is not a technical analysis course. You will not hear about moving averages, candlestick patterns, or secret indicators. This is about the invisible battlefield inside your own mind. It is about belief, perception, expectation, fear, confidence, and discipline. If you are listening to this, chances are you've already discovered that trading is not simply about having a good strategy. You can know exactly what to do and still not do it. You can know when to get in and when to get out, and you still hesitate, overtrade, cut winners too early, or let losers grow larger and larger. Mark Douglas understood this problem better than almost anyone. He spent years coaching traders, watching them sabotage themselves again and again, not because they lacked intelligence or information, but because they lacked the correct mindset. So in this long-form narration, we are going to unpack his core lessons in a structured, story-like journey. We will explore why trading feels so psychologically difficult, why your brain is not naturally wired for it, and how your beliefs and expectations create the very experiences you are trying to avoid. We will examine fear and overconfidence, the illusion of control, the obsession with being right, and the dangerous tendency to personalize trading outcomes. And then we will walk through the process of transformation, how to install a new mental framework step by step that allows you to operate in the markets with discipline, consistency, and emotional neutrality. Settle in. You can simply listen and imagine yourself in the examples that follow. Let the ideas sink in. This is not motivation. It is mental restructuring. Let's begin with the first big idea. Trading is a unique activity, and it demands a unique psychology. When most of us enter the world of trading, we come from environments where cause and effect are visible and relatively linear. We study, we get grades. We work, we get paid. We follow rules, we get predictable results. We are rewarded for being precise, for being right, for avoiding mistakes. Then we step into the market. Suddenly, we can follow all the rules and still lose money on a particular trade. We can break every rule we've ever set and still make a profit on that specific trade. At first, this feels confusing, random, even unfair. Mark Douglas points out that this randomness at the level of individual outcomes is one of the central psychological challenges of trading. Your brain yearns for stable patterns of cause and effect, but markets offer, at best, probabilities. You may have a setup that historically wins 55% of the time. That means you are going to have sequences of losing trades that feel like punishment, even when you are doing absolutely everything right. Most people are not prepared for that. They are prepared for a world in which effort equals reward, and doing the right thing gets you the right result most of the time. Trading is different. You can do everything right and still lose on this one particular trade. And you can do everything wrong and still win on this one particular trade. That is the first major psychological shock to the new trader. And how you respond to that shock will largely determine whether you become disciplined and successful or emotional and erratic. Mark Douglas argues that the majority of trading mistakes are not due to a lack of knowledge, but to a clash between the market's probabilistic nature and our need for certainty and emotional comfort. We bring our old mental models to a new environment where they simply do not fit. So let's define what discipline really means in this context. When most people hear the word discipline, they think of self-control, gritting your teeth, forcing yourself to do what you know you should. They think of willpower, pushing through discomfort. Mark Douglas offers a deeper view. For him, discipline is not forcing yourself in the moment. It is the natural expression of a belief system that is aligned with the way the market actually works. In other words, a truly disciplined trader does not have to exert enormous effort to follow their rules. Following the rules feels natural because those rules are rooted in beliefs they deeply accept. It is the undisciplined trader who is fighting themselves. They may have rules on paper, but internally, they still believe things like, I must be right on this trade. If this trade loses, it means I failed. I can't stand another loss. I have to make back what I just lost. I knew it. I should have taken that trade. I'll just move the stop this one time. The market is against me today. I deserve a win now. These beliefs are emotional and personal. They create tension, fear, anger, and hope, and those emotions pull them away from their stated rules. So the game, as Mark Douglas sees it, is not to develop superhuman discipline. The game is to identify and replace the beliefs that keep you from behaving with consistency. Let's move to the heart of his argument. The market is a neutral environment. It does not know you exist. It does not reward or punish you. It simply moves according to the forces of all participants, based on their own beliefs, timeframes, needs, and capital. Yet most traders, unconsciously, relate to the market as if it were a person. They believe the market is being unfair, that it is hunting their stops, that it is out to get them, or that it owes them something after a streak of losses. These are emotional projections. When you project agency and intention onto the market, it becomes a psychological opponent. You take every loss personally. You feel insulted, betrayed, even attacked. And as soon as you feel attacked, your fight or flight response turns on. You either freeze, hesitate, and miss trades, or you fight back impulsively, revenge trading, oversizing, or abandoning your plan. Mark Douglas insists that to be disciplined, you must accept the market's neutrality at a deep level. Every tick is information. It has no meaning beyond what you give it. The market is not right or wrong. You are not right or wrong. There is only alignment or misalignment between your position and the current flow of price. When you truly accept that, something powerful happens. Losses stop feeling like personal failures. They become a routine cost of doing business. Like consider a casino. A casino does not get upset when someone wins at blackjack or roulette. The casino knows the odds are in its favor over a large enough number of plays. Individual outcomes do not matter. Only the edge over time matters. That is exactly how Mark Douglas wants you to think. You are not trying to win this trade. You are trying to execute your edge over many trades. Any single trade is just one point in a long series. If you have a sound strategy with a positive expectancy, then your only real job is to take all your valid setups, manage risk, and allow the probabilities to play out. Now, here is where it gets interesting. You might intellectually agree with this. You may nod. You may say, yes, that makes sense. But then you see a setup. You know your rules say to take the trade. Yet you hesitate. You think, what if this is the one that loses? I just had 3 losers in a row. I can't take another loss. Emphasize. Or you jump in too big, hoping to make back earlier losses quickly. Emphasize. This is where Mark Douglas focuses on beliefs. Emphasize. Your actions do not reflect what you know. They reflect what you believe. You might know, logically, that the outcome of any one trade is uncertain. You might know that you have to take all valid setups to realize your edge. But deep down, you might still believe something else, such as, losses are bad. Losses mean I failed. Losses mean I'm not good enough. I have to win on this trade. If I just try harder, I can avoid losing trades. These are not market beliefs. They come from childhood, school, sports, family, culture, and previous experience. In most environments, mistakes are punished. Being wrong is shameful. We are praised for being right, for being smart, for being winners. So we learn to equate our self-worth with success. Then we bring that emotional link into trading. Suddenly, a losing trade does not just mean this particular probability turned out against me. Instead, it means I am not good. I am failing. I am losing status. I am in danger. No wonder trading feels so stressful. Mark Douglas's key insight is that these old belief patterns are incompatible with the probabilistic nature of trading. If you keep them, you will keep feeling that stress. You will keep avoiding necessary losses and chasing unnecessary risk. So the healing work, the transformation, is inner. He encourages traders to deliberately examine their beliefs about being wrong and losing, to see how those beliefs formed, to see that the market is not a parent, a teacher, a coach, or a judge. It is just a stream of prices. A disciplined trader, in his view, is someone who has separated their identity from their trading outcomes. Let's repeat that. A disciplined trader is someone who has separated their identity from their trading outcomes. This means you no longer see a losing trade as an attack on your self-worth. It is just information. It tells you whether your edge is still valid, whether your execution is consistent, or whether market conditions might be changing. This psychological neutrality is the ground on which discipline is built. Now let's talk about fear, because fear is at the center of most trading errors. There are several core fears that Mark Douglas identifies in traders. Fear of losing money, fear of being wrong, fear of missing out, fear of leaving money on the table. Each of these fears creates characteristic behaviors. Fear of losing money leads to hesitating to enter trades, cutting winners too early, moving stops further away, or refusing to take valid setups after a few losing trades. Fear of being wrong leads to not taking a stop when it is hit, holding on to losing trades too long, waiting for the market to come back, and adding to losers to avoid admitting defeat. Fear of missing out leads to chasing price, entering late, overtrading, taking marginal setups, and ignoring your plan. Fear of leaving money on the table leads to letting winners turn into losers, refusing to take partial profits, or ignoring exit rules in the hope of squeezing out every last pip or point. All of these behaviors destroy discipline. Now, Mark Douglas does not say, just stop being afraid. He knows that fear is an automatic response. You do not remove it by yelling at yourself. Instead, he argues that fear in trading is largely the result of unresolved beliefs and a lack of trust in your edge. If you genuinely understand and accept that any single trade is random relative to the next, and that your edge only plays out over a series of trades, then there is nothing to fear in any one trade. The risk is predefined. You know exactly how much you are willing to lose. Nothing unexpected is happening. The fear arises when you are either risking money you cannot afford to lose, or you have attached too much personal meaning to the outcome, or you do not really believe in your edge. So, to reduce fear, Mark Douglas suggests 3 foundational practices. First, always define your risk in advance of any trade. Know exactly how much you will lose if the trade does not work out, and make sure that amount is small enough that you can emotionally tolerate it without flinching. Second, accept the loss fully before you enter the trade. This means, imagine losing that amount and being okay with it. If you cannot accept that possibility in advance, you are not ready to take the trade. Third, commit to thinking in probabilities. Shift your focus away from individual trade outcomes and toward the performance of your edge over many trades. Your success is not in this trade. It is in the next 100. Let's explore this probabilistic thinking more deeply because it is central to Mark Douglas's philosophy. Imagine you have a coin that is weighted slightly in your favor. Let's say when you flip it, it comes up heads 55% of the time and tails 45% of the time over a very large number of flips. If every time you get heads, you win $1, and every time you get tails, you lose $1, then, over a large number of flips, you will make money. You have an edge. Now imagine that after 10 flips, you have 8 tails and only 2 heads. You are losing, but nothing is wrong. Long sequences of bad outcomes are possible, even likely, within a probabilistic framework. What matters is not those 10 flips. What matters is the next few hundred flips. The disciplined trader sees trading the same way. Your edge might be something like this. After a certain pattern appears, followed by a confirmation signal, price tends to move in your favor 60% of the time, with an average profit of 2 times your risk. If you faithfully execute this edge every time it appears, with consistent risk management, then over a large number of trades, you will likely make money. But if you skip trades when you are scared, or you size up too much when you are excited, or you exit too soon or too late based on emotion, you no longer have that edge. You have randomness. Mark Douglas's point is that consistency in trading cannot exist without a probabilistic mindset. If you are still thinking in terms of, "This trade must win," or "I can't afford another loss," then you are operating from a binary all-or-nothing perspective. You will feel intense emotional swings, and you will not follow your rules. Thinking in probabilities does not mean being careless. It means accepting that you do not know what will happen next, but you do not need to know. The outcome of the next trade is irrelevant. Only the long-term behavior of your edge matters. This leads to one of Mark Douglas's most powerful concepts. To be a disciplined trader, you must accept 4 fundamental truths. The first truth, anything can happen. The second truth, you do not need to know what is going to happen next to make money. The third truth, there is a random distribution between wins and losses for any given edge. The fourth truth, an edge is nothing more than an indication of a higher probability of one thing happening over another. Let's go through those slowly. Anything can happen. At any moment, a surprise event, a news release, an unexpected order, or a sudden cascade of buying or selling can completely change the price. The market has countless participants, each with their own information and intentions. No pattern is guaranteed. No level is unbreakable. No signal is infallible. If you deeply accept that anything can happen, you will stop relying on certainty. You will build your entire approach around managing risk in a world of uncertainty. You do not need to know what will happen next to make money. This is a liberating idea. You can stop trying to predict the future with absolute confidence. Instead, you can focus on identifying situations where the odds are slightly tilted in your favor, and then managing risk and reward effectively. A casino does not know which specific player will win or lose on the next hand. It simply knows the math over thousands of hands. That is enough. There is a random distribution between wins and losses for any given edge. This means that even if your strategy wins, say 60% of the time over hundreds of trades, you cannot know the sequence. You could have 10 wins in a row or 10 losses in a row, and both are consistent with a 60% edge. So you cannot rely on recent results to determine whether the next trade will win or lose. Each trade is unique. The previous outcomes do not force the next one to be a winner or a loser. An edge is nothing more than an indication of a higher probability of one thing happening over another. Your edge does not guarantee anything. It only nudges the odds in your favor. If you treat your edge as a certainty, you will be shocked and upset when losses come. If you treat it as a probability, you will calmly take each trade, knowing the edge will play out over time. Now let's connect this to the practical day-to-day experience of trading. Mark Douglas frequently encountered traders who would say, "I know my system works, but I just can't follow it consistently." He would ask them to describe exactly what happens. They might say, "I see the setup. Everything lines up. But I remember the last losing trade, and I start to think, what if this one loses too? So I pass. Then, of course, the trade works without me, and I get angry. Then I see the next setup, and I don't want to miss it, so I jump in late, or I take a marginal signal without waiting for full confirmation." Or they might say, "I enter the trade according to my plan, but as soon as it moves a little in my favor, I fear it will reverse and turn into a loss. So I take a small profit early, long before my target. Then I watch price keep moving in my original direction, hitting the level I originally planned. I then feel frustrated and think, next time I'll hold longer. But the next time I hold, the trade reverses and becomes a loss, and I feel stupid again. I refuse to get out at my stop. I keep moving it. I tell myself it's just a temporary pullback, or it can't go any lower. Then the loss grows larger than I ever intended. I finally exit at a much bigger loss, feeling devastated and ashamed. I then try to get back into the market quickly to make back what I lost, and that usually leads to more impulsive trades. These are the patterns of undisciplined trading. Mark Douglas's response is not to tell these traders to use more willpower. He knows that willpower collapses under emotional pressure. Instead, he emphasizes 3 pillars of disciplined trading. The first pillar, a clear, specific trading plan with well-defined rules. The second pillar, a firm risk management framework that protects you from catastrophic losses. The third pillar, a systematic process of mental conditioning to align your beliefs with your rules. Let's look more closely at each. A clear, specific trading plan means that you know in advance exactly under what conditions you will enter a trade, how much you will risk, where your stop will be placed, under what conditions you will exit with a loss, and under what conditions you will exit with a profit or partial profit. There is no ambiguity, no room for maybe. If the conditions are met, you take the trade. If they are not, you do nothing. A disciplined trader makes the plan very clear. The plan removes almost all guesswork. Risk management means you decide losses before you trade. You choose how much capital to risk per trade. You choose a limit for the trading day. You also choose limits for longer periods. Mark Douglas says, keep risk per trade very small. A losing streak should not break you mentally. A losing streak should not break you financially. If you risk too much, every trade feels heavy. Each trade becomes loaded with fear and hope. You cannot think clearly. You will experience fear. And fear will cause you to hesitate, violate rules, or interfere with trades in progress. The third pillar, mental conditioning, is the most unique contribution of Mark Douglas. He suggests that traders treat the development of discipline as a training process, similar to how an athlete trains their body. You are not simply hoping to be disciplined. You design exercises for your mind. For example, one powerful exercise is to deliberately commit to taking the next 20 valid setups according to your plan, no matter what, with small position sizes and with a written record of your thoughts before, during, and after each trade. The goal is not to make money during this exercise. The goal is to prove to yourself that you can follow your plan mechanically and to observe all the internal voices that try to stop you. You will hear thoughts such as, "This one does not look quite right. Maybe I should skip this one, it feels wrong. The last few trades lost, maybe I should wait. This setup looks too good, I should increase my size. I don't feel confident today, I'll only take the perfect trades. I need to make back what I lost. I'll bend the rules just this once." Your job in the exercise is to ignore those voices and follow the plan exactly. When you do this over a series of trades, you begin to discover something important. Your emotions do not need to determine your actions. You can feel fear and still act according to your rules. You can feel greed and still exit at your predetermined target. You can feel anger and still stop trading for the day when you hit your max loss limit. Mark Douglas insists that through repetition, your brain can gradually accept new beliefs. As you follow your rules over many trades, you start to see that a losing trade does not kill you. It is just another outcome. You start to see that missing one trade does not matter if you consistently take others. You start to see that the edge really does play out if you let it. This lived experience begins to override old, fear-based beliefs. Now, let's talk about a subtle but very important aspect of Mark Douglas's work, the avoidance of denial. Many traders live in denial. They deny the risk they are taking. They deny the possibility of big losses. They deny that their edge might be gone. They deny that they are breaking their own rules. Denial creates illusions of safety. But those illusions are fragile. When the market moves sharply against them, their illusions are shattered and they are left shocked and traumatized. Mark Douglas teaches that true confidence comes from embracing uncertainty, not hiding from it. Instead of pretending that your trade can't lose, you face the reality that it can. You define your stop. You accept that loss before you enter. You decide how many times in a row you can lose and still be okay. You think through worst-case scenarios in advance. By doing this, you remove the element of surprise. You are no longer blindsided. The market cannot shock you with something you have already mentally rehearsed and prepared for. This is what he means by accepting the risk. Accepting the risk is not merely knowing that risk exists. It is feeling emotionally at peace with it. It is being able to say and genuinely mean it, if this trade is a loser, I am okay. It does not threaten my identity, my lifestyle, or my long-term goals. When you truly accept the risk, fear loses its grip. You no longer freeze or fight when trades move against you. You follow your plan. Let's explore another recurring theme in The Disciplined Trader, the illusion of control. Human beings love to feel in control. We are deeply uncomfortable with randomness and uncertainty. When we win a trade, we often feel it is because we were smart, because we read the market correctly. When we lose, we may blame the market, the news, the broker, or bad luck. But Mark Douglas points out that much of what happens in trading is simply beyond your control. You cannot control what other participants will do. You cannot control sudden news events. You cannot control the sequence of wins and losses. All you can truly control is how much you risk, when you enter, when you exit, whether you follow your rules. The rest is not up to you. The illusion of control leads to frustration and overtrading. It leads traders to constantly tweak their systems, jump from strategy to strategy, chase the latest indicator or method, all in an attempt to find a formula that will eliminate uncertainty. But no such formula exists. The most powerful trader, in Mark Douglas's view, is the one who has surrendered the need to control outcomes and has focused entirely on controlling their own behavior. This is why he repeatedly uses the term trading in the zone in his later work. The zone is a state where you are fully engaged in the present moment, following your plan with confidence and detachment, not concerned with the outcome of any one trade, but fully aligned with your edge. To reach that state, you have to clear away mental clutter, beliefs that do not serve you, old emotional wounds, unrealistic expectations. Let's now talk about expectations, because they are a hidden source of pain in trading. When you place a trade, you naturally have an expectation. You expect the trade to win. You imagine how it will move. You imagine the profit you will make. Mark Douglas warns that excessively detailed or rigid expectations create emotional volatility. If you imagine a specific outcome too vividly and the market delivers something different, you feel disappointment, anger, or confusion. You become attached to a fantasy. Instead, he suggests holding flexible expectations. You can expect your edge to play out over time, but you remain open about how any specific trade will unfold. You might say to yourself, I do not know exactly how this trade will evolve. It might move quickly in my favor, or it might whipsaw. It might hit my stop. It might hit my target. All of these are possible. I have defined my risk and my plan. My job is to execute. The market will do what it does. This mental stance reduces emotional swings. The core idea here is non-attachment to outcome. This does not mean indifference to money. It means you are focused more on execution quality than on immediate profit or loss. Over time, when you focus on execution, your results naturally improve. When you focus on money, your execution becomes erratic. Let's turn now to self-sabotage and how Mark Douglas helps traders see and stop it. Self-sabotage in trading might look like this. You do well for a while. You follow your plan. You build up your account. Then, suddenly, you take a huge, undisciplined risk, wipe out a big portion of your gains, and find yourself back where you started or worse. You make steady progress and feel confident. Then, just when you are on the verge of a breakthrough, you start skipping trades, distracting yourself, changing your method, or making basic errors. Why would someone sabotage themselves? Mark Douglas explains that many traders have unconscious beliefs about success, money, and their own worthiness. Someone might believe, deep down, I do not deserve to be wealthy. If I make too much money, people will resent me. If I become successful, I will lose my current identity and relationships. Success will bring pressure and expectations I cannot handle. I am not really the kind of person who wins long term. These beliefs are rarely conscious, but they can drive behavior. When your trading performance starts to contradict these beliefs by moving toward consistent success, your unconscious mind may feel threatened and push you to do something that will restore the familiar reality of struggle or mediocrity. This is not mystical. It is psychological homeostasis. The mind loves the familiar, even when the familiar is painful. Mark Douglas invites traders to examine their deeper beliefs about wealth, success, and identity. To ask themselves, what do I really believe about rich people? What did my family say or imply about money? Do I feel comfortable imagining myself as a consistently profitable trader? What fears come up when I picture myself trading large size successfully? By bringing these beliefs into awareness, you can begin to question and update them. For instance, you might realize that as a child, you heard people say, rich people are greedy, or if someone has a lot, someone else has less. And now, you unconsciously fear that becoming wealthy through trading would make you a bad person. Once you see this, you can consciously choose a new belief, such as, I can be wealthy and generous, or my success does not take away from others. This inner work clears the way for discipline to become natural instead of forced. Let's return to the daily practice of building discipline, because theory alone is not enough. Mark Douglas emphasizes repetition and structure. One powerful routine might look like this. Before the trading day begins, you review your rules. You visualize yourself following them, even in challenging situations. You decide in advance how many trades you are willing to take, your risk per trade, and your maximum daily loss. You commit to stopping if you hit that limit. During the trading session, you log every trade. You write down why you took it, how you felt entering, and how you felt as it played out. You note whether you followed your rules perfectly or deviated. After the market closes, you review your performance, not in terms of profit and loss, but in terms of discipline. You ask, did I follow my plan? If I did not, what belief or emotion drove that deviation? What can I do tomorrow to anticipate and neutralize that pattern? You then rehearse the next day mentally, imagining yourself encountering similar situations and responding with discipline. This may sound tedious, but it is how you rewire your brain. Mark Douglas is clear, you cannot transform your trading psychology with one insight or one decision. It requires repeated action, just like building muscle or learning a language. Over time, with consistent practice, you will notice that situations that once triggered fear or impulsivity now feel neutral. You have installed new mental habits. Now let's talk about boredom, another silent killer of discipline. Sticking to a well-defined plan can feel boring, especially when the market is slow or when your strategy has few valid setups. Many traders, especially those who are naturally drawn to excitement and risk, find themselves chasing trades simply to feel engaged. Mark Douglas notes that boredom often leads to overtrading. A disciplined trader accepts boredom as part of the job. There will be stretches of time where the correct action is to do nothing, to wait, to sit on your hands, to be patient. If you associate trading with constant excitement, you will struggle to do this. You will feel compelled to create action where none is justified by your plan. So part of becoming disciplined is redefining what success feels like emotionally. Instead of seeking thrills, you learn to take satisfaction in calm precision, in saying no to trades that do not fit, in closing the platform when your rules say you are done. You begin to see discipline itself as the reward. Mark Douglas sometimes describes trading as a business. Your job is not to entertain yourself. Your job is to execute a process that, over time, extracts money from the market. If you need excitement, you can find it in hobbies, sports, travel, or other areas of life. The market is not the place to satisfy that need. Let's also discuss the difference between confident trading and reckless trading, because they can look very similar from the outside. A reckless trader might take big positions, hold through large drawdowns, or double down on losing trades. To someone inexperienced, this might look like bold confidence. But on the inside, it is driven by fear, desperation, or ego. A truly confident, disciplined trader may also commit fully to their trades, but they do so within strict risk limits, and they never gamble their capital on a single outcome. Mark Douglas defines real confidence as the result of having absolute trust in yourself to follow your rules. You might think of two parallel meters. One meter measures your account balance, which goes up and down with your trading results. The other meter measures your discipline, your consistency of execution. The disciplined trader tracks both, but places more weight on the second. They understand that if they keep their discipline meter high, the account balance will eventually follow. Mark Douglas invites traders to redefine success on any given day. Instead of saying, "I had a good day because I made money," or "I had a bad day because I lost money," you might say, "I had a good day because I followed my plan 100%, regardless of the outcome." Or you can choose another option instead. "I had a bad day because I broke my own rules, even if I ended up making money on those trades." This way of judging yourself maintains the integrity of your process. It prevents you from reinforcing bad habits just because they happen to pay off in the short term. Now, let's address a common question. Can anyone become a disciplined trader? It is not just money. It is a new relationship with uncertainty, risk, and your own emotions. You begin to carry this discipline into other areas of your life. You become less reactive, more thoughtful, and more resilient. Trading is an activity where uncertainty is permanent. You cannot eliminate risk. You cannot predict every outcome. You can only find edges, manage risk, and execute consistently. Most trading problems are mental, not technical. The issue is not the system, it is your ability to follow it. Your beliefs about being wrong, about losing, about money, and about yourself are constantly influencing your behavior in the market. If those beliefs are rooted in fear, shame, or unrealistic expectations, they will sabotage you. Discipline is not raw willpower. It is the natural behavior that emerges when your beliefs are aligned with the realities of the market. When you truly accept risk, uncertainty, and the random distribution of wins and losses, following your rules becomes easier. Thinking in probabilities is essential. Any one trade means nothing by itself. What matters is how well you execute your edge over a long series of trades. You build discipline through structure and repetition, a clear plan, strict risk rules, and regular review of your actions, focusing on process rather than profit. You must separate your self-worth from your trading results. You are not your last trade. You are the quality of your decisions and your ability to follow your plan. You must uncover and update any unconscious beliefs that make success feel unsafe or undeserved, so you stop sabotaging yourself when you start to do well. And finally, you must learn to find satisfaction not in the excitement of impulsive risk, but in the quiet confidence of consistent execution. Mark Douglas's The Disciplined Trader is more than a book about trading. It is a manual for mental transformation. It says, in effect, if you want to win in the markets, you must first win the inner game. You must become a different kind of person, one who can act without fear in an uncertain environment, one who respects risk without being paralyzed by it, and one who values discipline above drama. As you reflect on what you have heard, you might ask yourself a few questions. Where do I see my own fear in trading? Which belief about losing or being wrong is causing me the most pain? Do I truly think in probabilities, or am I still fixated on each individual trade? Do I judge my days by profit and loss, or by how well I followed my plan? Am I willing to commit to a structured process of mental training, not just system development? The answers to those questions will tell you where you are right now on the path to becoming a disciplined trader. The good news, according to Mark Douglas, is that discipline is learnable. You do not need to be perfect. You just need to be willing to see yourself clearly, to take responsibility for your actions, and to keep refining both your method and your mindset. If you do, the markets can become less of an emotional roller coaster and more of a professional arena where you operate with calm, clarity, and confidence. Discipline is not a cage. It is freedom. Freedom from fear. Freedom from chaos. Freedom from the need to be right. It is the freedom to engage with the market exactly as it is, uncertain, neutral, and full of opportunity for those who can navigate it with a clear mind and a steady hand. Thank you for listening.